Hold on here. Okay, yeah, now we're recording. Hey there, guys. Episode 5. I've confirmed 3 times already with Sheldon, so I'm pretty confident it's episode 5. And I'm with Chris with FBC. We'll be talking about tax changes. Okay, guys. So let's get started. I think first things first, Chris. I don't want to put you on the spot too much, but just a brief introduction of who you are, and because you've got a bit of a track record there. You've been to how many schools? How many degrees do you got again?
A couple diplomas and a degree down there at University of Washington, and studied at Olds College here in Alberta when I moved out to Calgary a number of years back, and then found myself up here in the Peace Country. Yeah,
lucky you. Yeah, so you kind of have to be built for the cold if you move up here.
Yeah, I had no idea what I was getting into coming from Victoria. It's the warmest place in Canada for 6 months of the year. I think it snowed 3 times before I came up to Alberta here.
Yeah, that's pretty good.
That's awesome. Be gone the next day.
Yeah, and well, at least you don't get rained on every day here.
About 200 days a year.
Yeah. Yeah, that's the thing. I talked to quite a few BC boys, and they're like, "Wow, you guys have so much sun up here." We always get compliments for our sun. So
I trade the sun for the rain any day.
Yeah. I'm the same way. So the tax changes that are in effect, right? October 3rd, they were not effect.
There was a consultation period, 75 days that ended October 3rd. And then there was a vote in the House to extend that period to January 1st. It was spearheaded actually by some Liberal MPs that are in a bit of trouble right now from the looks of it. So a lot of controversy, obviously, with everything that's coming forward. There's been drafted legislation on 2 of the 3 proposed tax changes that, if they go through, will come into effect January 1st of 2018.
So when you mean drafted 2 of the 3, is there any changes, or are they're going through unchanged, unchallenged kind of thing?
It looks like there won't be too much change to what's been proposed so far.
Yeah. But potentially still some change?
Potentially still some change.
Okay. Good. Because there is quite a bit of changes, right? If you break it down. And, can I go on a rant just for a second? Because I was actually very offended when I was...
Go for it, actually, because I was going to say, I'm probably not going to say that much this podcast, because the 2 Chris's seem to be on the same page here in a lot of things, and this is stuff that's kind of out of my realm, so I'm just going to kind of sit back and watch and try not to say the extreme amount of the phrase
We're going to be throwing a lot of tax jargon, but when it really comes down to it, this affects you the most.
Yeah.
Well, that's why I want to listen to what you guys have to talk about. And actually, maybe before we get started, maybe Chris, if you want to describe a little bit, because we had a really good conversation for about an hour before we got started, and maybe describe a little bit about what you do versus what CPAs do and stuff like that, so everybody can kind of understand the difference between what your title is and what CPAs, accountants, bookkeepers do, because I thought that was actually very good and a lot more helpful to business owners than your typical routes and means of
an accountant.
Yeah.
Right, so I'm a tax consultant. It's my job to look at not only this year, but next year, and the next 5 years, and the next 10 years, how certain investments...
Sorry, you're 6'8", right? Sorry, just
big
trying
guy. We're super tall.
Just get a little closer to the mic.
Right there.
Yeah, awesome.
That's good.
You're going to be hunched over. There you go. Sorry.
So we want to be proactive, right?
Yeah.
We want to be looking at what not only is happening this year, but what's happening over the next 5 years, or what the plan is is to eventually sell or to grow, where those investments want to be over the long term, and how we can make the long term make you pay less tax. We want to make the tax code work for you. That's the difference between me and like a CPA. CPA is tracking the money in your company. A tax consultant is using the tax code to make your business more efficient when it comes to their tax liability.
Yeah, the way I see it is, most accountants and corporate accountants are more reactive, right? They'll do your corporate year end. You'll see them at the end of your, operating year, your fiscal year, and they go through your books, and they, a typical accountant, CA or otherwise, is usually reactionary. And I find your role is a little bit different. It's kind of proactive in a sense, right? Where you're kind of looking at the next 2-3 years in a different way. So
I was super impressed with our conversation. And like I said, lots of the stuff you brought up in the first 10 minutes of us talking was stuff I've never heard a CPA or accountant say before about tax strategy, tax planning, and all these things that you never hear about. So I was super impressed, and I'm definitely going to be using somebody like yourself moving forward rather than your traditional means, because I can see the long-term benefit over just taking your stuff to an H&R Block or an MMP or whatever it might be. As good as those people are, I can definitely see somebody like yourself getting more hands-on and involved with your business and the inner workings of it, and making a strategic plan for your business moving forward. And it's very tough to find. Being, a small business owner for a number of years myself, you can ask anybody. I've always said the biggest frustration for myself was always bookkeepers throughout the year and accountants at the end of the year. Always. But you've said a lot of good things tonight, and hopefully, everybody listening will get some value out of that for sure. So,
yeah, I mean, for me, I think it's very important to kind of lead the way for your company financially. I find if your accountant is making too many business decisions for you, that could be good if you don't have much experience in the way of cash flow management and the vision of the business and stuff. You're kind of giving away the vision of the business to the accountant at that point. But I find that, if you can lead the way and kind of guide your accountant through a T2 and how you want your read-only statements to look and stuff like that, I think that should be the goal of every entrepreneur, right?
Yeah, but I find a lot of people don't understand or know that stuff very well, where I feel guys like Chris do. And I feel people, and I even said it in our conversation before, typically what I found is, I was, especially when I was smaller, business-wise, I was always looking for bookkeepers, accountants, to give me the answers to how to grow what I should be doing. But what I said before earlier was, they're not business owners either. They're very good at putting a package together to submit to CRA, but they are not business owners. They do not understand the needs of small business owners, and they do not understand how to run a small business. Whereas from our conversation, I feel like somebody like yourself, like a tax strategist or tax professional, would have a lot of those elements kind of understood and kind of.
And as somebody who's preparing tax returns, it seems obviously my busiest time is January to April. That's when I'm seeing every single one of my members, and then through the year, I'm working with odd corporate year ends and bookkeeping. But starting right about now to the end of the year is my second busiest time of the year, as busy as tax season. Because I'm trying to see as many people as I can, and we're working on that tax plan going forward. Seeing if there's anything we can do before the end of the year to reduce your tax liability going forward, and to just reassess the plan that we had last year and see, is this working? Is it going as planned? Was there any unexpected things that came up throughout the year? Did you have to do some big repairs that are bringing you lower, or are you did you have unexpected sales that went forward, big deals that went through, and what can we do to mitigate that this year, and what can we start in motion to reduce your tax liability next year and 5 years down the line?
Yeah, for sure.
Yeah, it's an interesting. I mean, we could debate this. I could talk about this all night. I mean, how you can maximize the efficiency when you use an accountant, right? There's so many perspectives there. And it really, I think it's per individual. Some people, really need that added touch from an accountant. And then I look at a guy like myself and I go, okay, well, give me the options. Give me options. We'll break it down. And then I want to take the option that best, at least fits the vision of the company, right? Because to be honest, when it comes to accounting, I feel like I only know just a small sliver of it at the end of the day. So I feel like I'm just constantly trying to improve and understand it better each time, Like it was only recently, I want to say maybe 2 years ago, we started tracking cash conversion cycles, right? Prior to that, it was kind of like, oh, what's a cash conversion cycle, right?
So again, we've talked about it before, is that book Scaling Up by Vern, where it talks about, we literally said in our previous podcast that book is literally a handbook on the financial basics of your business, and cash conversion cycles was on there. Yeah, we were like, what the fuck is a cash conversion cycle when we first got started? But,
and then, we could actually use this.
Yeah, but now, we realize how important that stuff is, right?
Yeah.
You talk about options, and that's one of the things that is really important to us, because when it really comes at the end, it's your responsibility to file your company's T2, and it's your responsibility and Sheldon's responsibility to file your own personal taxes, right? And if there's a plan in place, you should be asking your accountant for options and what else you can do next year, and what else can be done. I'm less interested in collecting a stack of books at the end of the year and saying, here's what you're going to have to pay in tax. That's not interesting to me. I want to be able to say, what can we do to actually have a plan that's going to reduce taxes over the long term?
Yeah.
I want to present you with options.
Yeah,
so it's your choice.
And not to take away from what you said, because I think that's very valuable. Because I hear it all the time. Like, oh, my accountant told me I had to spend $50,000 or else I'm going to pay tax. Well, let's take a step back. What's the goal of the corporation?
I hate
what's
that
the goal
statement.
It's crazy.
You only pay tax
when you make money.
Yeah, but
it's the weirdest thing.
But but here's the thing, they don't want to pay tax because their accountant. So then they go out. This guy, and I'm not going to name names.
Okay.
Point. But he goes out and he spends $50,000 on a trailer. Well, now you've got more assets in your company. Right now, what's the plan here? What's the play? Now
exactly.
It's like
to go spend $1 to save 30 cents doesn't
really
make sense to me.
Yeah. It's crazy. Yeah. So not to take it out of context, obviously, you have to assess your situation. You have to be honest with yourself and have a good person on your team in the accounting realm to help you.
Yeah.
But there's I can take it out of context 12 ways from Sunday, but I just hate it when someone's like, oh, my accountant told me to spend $50,000 so I wouldn't have to pay any tax.
Now you do want to in a corporation, it's not going to make as big of a deal, especially if you're in that small business tax bracket under $500,000 of taxable income. You're all under one tax bracket. But on the personal side, we see this all the time where somebody needs to buy that trailer. Does it make more sense to buy it this year or next year? What's your taxable income?
And then you can time the purchase in a tax advantageous way, right?
Yes, exactly. That makes more sense than rather just saying, well, okay, so we were talking about this before too, on how we grew up, on dairy farms and stuff like that. Do you want to know the amount of times I heard farmers say, at the end of the year, I need to spend $30,000, $40,000, $50,000, $100,000, whatever it is, I gotta go buy a new tractor because my accountant said so. I was just like, that doesn't make sense to me.
Crazy. Yep. And one stat while we're throwing stuff around, return on net assets is so important to us. Like it's crazy. I mean, let's say you have a company, it's cash flowing $100,000. Would you rather that company have $1 million worth of assets or $100,000 worth of assets? It still cash flows the same, right? And a lot of people go, ooh, the million, right? Yeah. But the problem is, if you're trying to purchase one of the two, the latter is way easier to occupy because you put a multiple on that plus assets. What was that sound? Just random noises going on. But
it's my kid's room right above us. She's obviously not sleeping. Anyway.
Yes, good times. So anyway, I want to rant. Just one second. One thing that really bugged me about the tax changes, and it was it really had me worked up was
Just one thing.
well, there's multiple.
There's a
things,
few things,
actually. but we only have so much time, and I don't want to put anybody to sleep. But the problem that our current government was doing was they were like. There's this one example, like Sue makes $200,000, and Joy makes $200,000, and if Sue, the employee, is going to pay, I don't know, $67,000 or $70,000 worth of tax, and Joy, because she's an entrepreneur, is going to spend $44,000, and then all of a sudden it paints all these entrepreneurs like they're dodging 20, 30 grand worth of tax. So first of all, the first thing is, I think whoever drafted up that example should really be banned from making an assessment, like a comparable assessment, because that is not realistic. Most entrepreneurs are making about $45,000 a year, first of all. So it's not like 30 grand or 40 grand in tax they're saving. They're typically saving like 2, 3 if they're lucky. But then they have the added accounting expense too if they have a corporation. So maybe they're saving some money. I mean, you could break down numbers, but all I'm saying is, first off, I don't like it's. I get it. They're trying to push their agenda, and that's the aggressive scenario that helps prove their point. Right?
But wait, Chris, are you saying that the politicians are not connected with their constituents?
I'm just saying that whoever wrote that is like they don't have a clue about being an entrepreneur. Because here's the other thing. Okay, Joy makes 200 grand, the same as their employee counterpart. But how much? First of all, 9 out of 10 companies fail within the first 5 years. So Joy's one of the 10 that survived. So she didn't lose everything. So kudos to her, first of all. The second, how many years of financial sacrifice did it take her to get to that point? And I feel like the whole picture isn't really being put on the table, because maybe Joy paid herself half of what her comparable employee would have paid her for several years.
Look, I was going to say, if you can pay yourself 100 grand for 5 years when you're sacrificing, fuck. It's probably more like 0 to 40 grand for the first 5 years.
Yeah. For a lot of people, that's the case, right? Like, again, the average entrepreneur makes 45 grand a year. So to me, it's absolutely absurd where they're getting their compare. I get it. They're trying to find like the most aggressive argument possible and bringing it to the table. But man, it's just like, this is completely unreasonable.
Yeah.
So I feel like you're almost falling into you're a victim of the sound bites in a way, because Jane exists. Mm-hmm. And Joy exists. Those examples are real examples. They're people like that fall into those examples.
Yeah.
What people aren't realizing is that when you incorporate, you've created a new tax entity.
Yeah.
Okay. And if that tax entity is earning $200,000 of taxable income, they have a prescribed rate, but that tax entity isn't paying for your groceries, isn't paying for your house, presumably. Isn't paying for your trip to Mexico. Yeah. So at the end of the day, you only have so much income as your tax entity has given to you through a wage or a dividend or a management fees, however that structure is. Yeah. You're still paying that personal income. So where the tax savings are is when your tax entity issues you personally a dividend, and you're paying tax on that. So you're paying tax on, say, $60,000. From that tax entity, and you're paying at the same rate as the nurse who's making $60,000 a year. Yeah. Where people are getting caught up is that there's these savings in the corporation, and thinking that those savings are your savings.
Yeah.
But they're really that corporation savings.
Yeah, it's important because if there's a couple of bad years, right, you need that cash so that you don't just lose all your employees and go broke and you're done, right? Yeah.
You may be the shareholder, but that's not your money. That's the corporation's money. Yeah. It's not your money till you issue the dividend,
it's transferred out,
or you pay the remittance on it, and you pay the personal tax on it.
Yeah.
So to me, it feels like a straw man argument to say Jane is benefiting by only paying herself $60,000 and saving X amount in tax dollars. Well, that's only $60,000 that she's allowed to spend on her groceries, her kids, her vacation, whatever the case is.
Yeah, yeah.
The corporation is only liable to its own expenses.
Yeah.
To make the business functional.
Yeah, I mean, it's it's crazy too, because I mean, you know, let's say, first of all, that is a rare argument, like a rare, super rare position. But I feel it wouldn't be as strong of an argument if you threw in like what the average entrepreneur was actually doing.
Absolutely.
Right? Because I mean, if you think about it, like let's say you take a 50% salary cut and now you can't income split. Like, oh man, every dollar counts, you know, like, you know, whether it's 40 or 60 grand or something, you got kids and, you know, so all of a sudden what income splitting will save you some money for sure. But, like, if you had you not started the job and you just kept if you not started the business and you just kept your original job in the first place, I mean, you would have made more money, arguably. So it's kind of an interesting situation. I wish they would put the whole picture on the table, and I feel like they've just taken a sliver of it. So.
Yeah, and most of those entrepreneurs that you're talking about are falling into that category of between 45 taxable, 45,000 in taxable income to the 92 bracket, right? And so by splitting income, you're saving around 5% on any earnings over $45,000. So it's not a huge amount of savings. Now, once you start talking about 92 to 150,000. The savings are bigger, but you know, arguably somebody who's taking home between 92 and 150 has other options available to them too. They're using their TFSAs and their RRSPs to find they're targeting taxable rates, right? Yeah. So to save them more tax dollars.
Yeah, it's and it's just income splitting as well, right? So you got income splitting, and then you've got dividend, which now is, under my understanding, and hopefully you can clear this up for me, now there's going to be more of an accounting cost to it, right? Because now there's eligible and non-eligible, like there's more parameters around it, and
the eligible and non-eligible aren't going to be changing. What's going to be changing for CCPC, the Canadian Controlled Private Corporation, is how shareholders who are family members are treated.
Oh, right, because if you're under 24.
So currently the law is if you have a child or a family member at non-arm's length who's a minor under 18, and they're issued a dividend, they're taxed at the highest personal tax bracket. And it makes sense. You're giving a bunch of money to your little kid. Yeah, they're going to get taxed at the highest bracket. It's tax avoidance. Is sort of what they're trying to circumnavigate. The new law, the drafted legislation, will raise that age to 24 for a shareholder, unless they can show that they're an active employee of the company. And the idea being somebody who's aged 18 to 24 is likely going to have a lower level of input to your company. And then at age 25, if you have a child who's a shareholder and receiving a dividend, they must have assumed some risk in the corporation, in the company, to be taxed at their normal rate. So if I have an adult child who I'm funneling money to you know, for whatever.
Adult child, that sounds like Sheldon.
I'm sorry. I'm not going to dispute that. Actually, that's a perfect description of me.
I just said sorry to interrupt.
Chris.
I hadn't had any jabs in yet, so I had to get a jab.
I was expecting to be rolling this whole time. The idea to as it stands now, that adult child will be taxed at the highest personal tax rate unless they can prove in some way that they've assumed risk. Now, we don't have a definition for what assumed risk is.
I was just going to ask that, actually.
Yeah, no. So is that
does that mean
presumably it's not time logs or like a calendar, because that's the 18 to 24. If I've got a kid who's working in my business, I've got to say these are the hours they worked, and I paid them a reasonable wage.
That's the part that bugs me too, is reasonable. You know, that term reasonable.
My kid can work better than your kid, so he deserves more.
Yeah, well, and the thing is, like, okay, 100K. Well, someone can do that for 80, so that's unreasonable, right?
Yeah.
Like, Like, at what point?
And so presumably there'll be break points where you're paying a reasonable wage of $50,000 or $60,000 to your kid to do X job, and if I issue them $1,000 in dividend because I've issued you Class C shares, non-voting shares in my corporation, so I can give you that dividend. The remaining 40 or 50,000 above what's reasonable is going to be taxed at the highest rate. So
yeah. I mean, the whole topic of reasonable is just kind of cracks me up. Now, granted, I understand I have a biased opinion, right? Like, I'm an entrepreneur, I have corporations, I would like to pay the lowest tax rate possible. But, we know guys, that, for example, the CRA would, communicate to him, oh, your marketing's too high. That's unreasonable, right?
We've literally, a friend of mine literally had that.
The amount of marketing you spend is unreasonable.
They didn't believe him because the amount of marketing was too high, so they wouldn't let him claim all of it.
That's insane.
Okay,
that's insane.
So my job in that scenario is to say your advertising costs are higher. What is your taxable trend over a couple of years? Are you actually growing? Is your business growing? And if you have higher net profits year over year, then it makes sense that you're paying more into.
Yeah, there's more of a story there.
So it's my job as a tax consultant to work with CRA and works through some of those arguments.
Which is great. I just find it absolutely hilarious that a CRA auditor will call you or communicate with you, send you a document, and say, you spent too much on marketing. We can't allow these deductions.
When you got a small business, I should be able to spend, if I want to grow my business, I should be able to spend 100% of my profits if I want to, and to spend it to grow my business, and it shouldn't be a goddamn problem.
Well, and it's just hilarious. So, I mean, how much experience and training do these individuals have to deem what is reasonable and unreasonable?
Oh, a lot of them are summer students.
Yeah, well,
my God.
Sheldon, you have too many haircuts. I deem that unreasonable. Oh, sorry, I had to get that.
It's coming. Anyway.
Sorry, I cut you off.
No. Yeah, that's just crazy to me. I've never heard that before about people that work at.
No, it's true. I mean, you think of all the processing reviews and reassessments that happen between May and September. That's really what it is. They hire up summer students that are finishing at the end of April. That's right when they're getting their biggest volume of new stuff. That's why all these. That's why when you send in your T1 on the 15th of April, right near your deadline, it'll be processed faster than if you were to be late and file in October. You'd think that there's a bunch of people just sitting around from September till the end of the year waiting for tax season to start again so they can start processing T1 reviews. It doesn't happen. They're all in school.
That's funny. Okay, so
the small business owners are the ones who are the crooks in this country.
Well, it's just funny. Like, that's why I kind of got us down this path, because I'm glad we brought this up, because like the whole reasonable thing, I mean, where does that stop? Where does that end?
How many of those, summer students or any CRA agents have businesses? And that's exactly right. How the fuck do they know it's reasonable?
Yeah.
How many businesses?
Because every business is so unique,
have they had?
Right?
Exactly.
Like, every business model is so unique.
Yeah, and every industry is different. Like, that's such a bullshit statement.
Yeah.
And by region as well. People are getting paid different amounts in Alberta than they are in Nova Scotia or Ontario.
So the other funny thing, too, is this gentleman has a very nice car, right? And if I understand correctly, it's an unreasonable car? Or is that...
I don't remember. I don't remember, but I do know those cars have logos on them now. They are an expendable.
Jason, you got to get the logo off your car.
No, man. Actually, they look pretty kick-ass. I gotta say, I do like them. Anyway,
the car looks beautiful.
Oh,
the car looks beautiful.
But that's actually something that I get asked about a lot. when a vehicle gets deemed a luxury vehicle, and this could be your F-350 with an extended cab, all of a sudden is a luxury vehicle as opposed to a work vehicle.
Okay, how about this? How about we start a new business today and we service high-end customers, and we drive them around in our high-end car, but it's not all the time.
Now people get really worked up about this because you're limited to $30,000 that you're allowed to write off as a capital expense, right?
Say that again, sorry, just so I understand. So
I bought a luxury vehicle. I bought an F-350 with an extended cab as opposed to a normal.
Ooh, that's luxurious.
This is luxury.
Nobody buys an extended cab anymore.
It's got the power windows.
This is 1989.
Nice.
Got the fucking extended cab.
Huh? That's nice.
So that truck may have cost me $50,000, but
Yeah.
I'm limited to being able to depreciate $30,000. Okay, because it's a class 10.1.
Okay, yeah,
It's a
okay.
luxury
I
vehicle.
understand where you're going with it now, yeah.
All right. I'm only allowed to depreciate $30,000, but when I go and sell that truck, there's no recapture on it. So if I have my $50,000 truck that is eligible to depreciate the entire thing, I could bring it all the way down to zero over the next however many years. But when I go and sell it, I'm going to have to pay all that tax back. That's how a recapture works, right? Unless I go and replace it with another $50,000 truck. With the luxury vehicles, I'm limited to $30,000 that I'm allowed to depreciate, but there's no recapture on it. So depending on what your values are, you could be better off buying a luxury vehicle that might be $35,000 or $40,000, your buddy's car. I don't know. $30,000,
$35,000 or $40,000.
When's it unreasonable? Yeah, like okay, that Honda Civic that you drive, that's a reasonable car. But that Lamborghini, that's unreasonable. You can't drive that. We're not.
Well,
That's not an allowable deduction. I get. Well, that's what I mean, right? Like just start a new transport company. Just the Lambo Uber service. There you go.
Yeah.
Huh?
And that's what we were talking about earlier. When you're about to do something like that, you want to go to CRA and get a ruling on it beforehand.
Yeah. Do you want to explain that?
Yeah, we were talking
was
about
pretty
that
cool.
before, actually, and that was a super awesome point that I've never heard before. So yeah, please explain what the rulings are with the CRA in regards to luxury cars or like any other things that you might want to deem as an expense as a small business or even a big business before you do them.
Okay, so in the example of a luxury car, we weren't talking about this one earlier, but say I've got transportation. I'm driving people, Uber, something like that, right?
Yeah.
And I want a higher end car. It may be deemed a passenger vehicle, it's deemed a luxury vehicle, but I can get a ruling ahead of time saying I need this class of car, I need this style of car to maximize my business. It's required for my business.
Mm-hmm.
So it'll be actually accepted as a regular class 10 asset, be able to depreciate the whole thing. I can call and ask for a ruling to make sure that that's all legit. So I've got a plan and I want to ask them and say, this is what I want to do, is it okay? Now we were talking about the people at CRA are just people, right? So if I call and somebody says no, the first thing I'm doing is hanging up the phone and calling again and asking the next person that answers the phone, can we do this plan?
Yeah.
Sometimes it comes down to there's a big gray area and it's up to interpretation to the agent that you're speaking to. And these people aren't going to be the students, the summer students. They're going to be, in most cases, they're going to be full-time agents at CRA, and it's just about asking over and over, make sure you get that ruling ahead of time, so that you're not running into unexpected consequences down the line.
Yeah, but what you're saying was like, if you don't get what the answer you want the first time, you
call
can call
back.
back. I don't know how many times you can call back, but at least 2, 3, 4 times. I don't know.
Yeah,
but
at some point.
if you keep talking to different people, you might get the answer you want, and it's kind of like
That's why
that's so messed up.
It's crazy. Yeah. So there's so much vagueness and it's open to interpretation and so there is no real black and white and gray and all this. I don't know. I think people say gray just to scare off people from certain transactions, to be honest, that are perfectly legal. I think really it should just be legal and illegal. Just tell me what's legal and what I can do, and what's illegal and what I can't do, and I'll just won't do what I can't do. I'll just do what I,
That would be good in a perfect world. But in the world we operate in today, honestly, I love gray.
Yeah.
All the money, lots of the money, most of the money is made in the gray area. So that's why I love it, but I agree with you. If it could be,
they
just
call
tell
it
me
gray.
what I can do and can't do and make it consistent, and, I'll operate in the legal area every time.
I think that's just rhetoric, when they say gray. Like, honestly, it's just rhetoric.
Yeah.
Like, it's just a transaction, really, at the end of the day. Does CRA allow it or disallow it? That's it.
Yeah. No, in a lot of those cases, a lot of the people say the tax code is a lot of gray areas. No, it is a 1,200 page book, and it's really heavy. It's really big.
And all the text is black. There's no gray text.
It's all black and white. But if you find yourself in a situation where you have a plan that kind of falls in that in between space, call and get a ruling. And you can call a couple times and try and talk to the right person and change your argument, tweak it a little bit so that it does fall closer on one side. But if you just go ahead and do something and then you get assessed a different way, that's kind of it. That's kind of the end of the line. So get that ruling ahead of time. Make sure it's okay, and make sure you're working in the legal bounds, because you can make the tax code work for you.
See, and that was amazing. That I've actually got so much out of our conversation before this and during this. It's been amazing. But just to wrap this up, this podcast anyway. So, what are some of the most common things? And I think that was a really good point to kind of transition to. Some of the things that people might not know about, as business owners, what can I do, what can't I do, and get the ruling ahead of time. I had no idea you could do that.
Yeah,
but what are some of the very most common things you see small business owners, number one, make mistakes in, or number two, what can they be doing ahead of time to kind of, eliminate issues down the road? And I think getting a ruling ahead of time, that was kind of actually an eye-opener for me. Had no idea. Is there any other very common things like that?
No, that's the only.
That's the only. I've ever seen one. Okay, well that's it for the podcast.
No, lots of things, and a lot of it comes down to how you're managing money flow or cash flow from your business to the personal side.
And do you feel most people do a good job of that?
No, I find most people do a terrible job of that.
Hey,
surprise!
Wow, I didn't expect that. Go ahead.
So most commonly we see the one man corporation. Or one woman corporation. Small business, and not making any remittances. They don't have any employees, and so they're just paying for personal shit out of their business account.
Yeah, very common.
Right? Yeah. And thinking I can write everything off. Not realizing that when the CRA agent looks at a bookkeeping entry for Safeway, it's getting tossed out. It's going to shareholder loan. There's just no argument.
There's no way.
So.
And that's 101, by the way. Like I feel a lot of people get stuck on that. You want to separate it, and then if it's a shareholder loan, that's cool. Like we have shareholder loans going, credits and debits going in and out of that all the time. But like that's 101. You can't your business shouldn't be able to buy your donuts going through Tim Hortons unless right? So but I understand what you mean by it.
And by the way,
it's meals and entertainment. Donuts are meals and entertainment, right?
They're meals and entertainment, which are written off at 50%, unless you're going to a sales call or you're in public and you hand them out to a stranger on the street and say, "Hey, here I have a donut from whomever." Then all of a sudden it's written off at 100% for advertising.
Marketing. Fucking snap.
Yeah.
There you go.
So how you enter it into your lines of expenses is a big deal too, right?
And make notes on your receipts. That's one of the biggest ways to protect yourself. To say
because the CRA could easily go in and go 50% on all this. Wait, this is a note
those
here.
Donuts were getting
you dropped this off at a customer's office
versus they weren't for the employees. Great point, actually. That's
and the same thing. I run across this all the time. Somebody who's bought up a bottle of booze for a client, That's the difference of 0%.
Zero.
Shareholder loan
Yeah.
versus 100% at advertising.
So next time you come over, are you buying the booze then or what?
That's what I
Okay, I didn't indulge in your.
There's no obligation. There's no obligation. Don't worry.
Yes, there is. Anyway.
So obviously, how long do you want to take this?
Well, I think we should wrap this one up, and then if we want to do another one, we can. But
I just want to note. I set this one up. I pressed record on the phone. Everything worked well. And how long did we wait to get set up? It was like 5 minutes. So I'm just bragging a little bit. I think I did a pretty good job here. I'm just saying. So, yeah. But anyway, go ahead. Yeah.
No, that's it. I think super valuable information. I am super impressed with you and your business. To be honest, I think anybody who has a small business, has a one man or woman corporation, all that kind of stuff, should be seeing a tax specialist such as Chris. Rather than a CPA or an accountant, because man alive, have my eyes been open tonight alone.
Yeah, and I think for larger operations too, like ours, I mean, we use multiple individuals, right? Like we use multiple accountants. We get consultants. We work with literally a team of people, and so there is that point where you have to build a team, and it's always great to get multiple perspectives as well, because one accountant might not fit the vision of and the direction you want to go.
And most of them aren't business owners.
Yeah,
and there's a huge goddamn difference between the two.
Yeah. So at the end of the day, I think you got to do your due diligence and really just try and improve your education, your own education on accounting. That way, it'll help you make decisions and understand the options that they're giving you in the first place. Because if you don't understand the jargon that Chris is saying, you're in trouble. You're operating at a disadvantage against your competitors. So anyway, long story short, you guys want to do a second one? What's your time like? You good?
I got Thanksgiving on Monday.
Okay, we could probably do an extra one then. So because we didn't go over the tax changes.
We
talked about the first one.
Yes,
and we said that there was draft legislation for the third one.
Yeah. Yes. Okay. So the next one, you want to get into capital gains?
Long one.
Yeah, we can. Let's go into capital gains in a second. Okay, cool.
Yeah.
So thank you guys. Stay tuned for the 6th episode, because I can indeed count. See ya.